Hello, and welcome back. There has been a request to take a look at JD.com, and it makes total sense as the stock is actually heading downwards for a while now, along with the overall Chinese economy. But it may just be a great opportunity for a potential buy here, and I wanted to make a dedicated video, take a little bit of a closer look. Now, the first thing that I want to take a look at before examining the actual financials and taking a look at the charts of the company's performance, I wanted to take a look at what has happened. So you'll see that JD.com hits an all-time low amid mass downgrades and arrest rumors, which is interesting to see. Now, it continues to plummet on the Hong Kong Stock Exchange after hitting an all-time low this week, after the Wall Street has turned bearish on the stock. Now, there have been rumors about the arrest of company's chairman Richard Liu, though nothing has been confirmed, as you'll see over here. But amidst this opportunity, amidst this downturn, it may just be an interesting case for a potential buy because, again, all these things are more than likely temporary and they are about sentiment, they are about the overall Chinese economy, which is a known thing, of course, and it has definitely inflicted some pain throughout the Chinese economy and the Chinese stocks. But again, this is when we typically buy as long as the company's financials are up to it, right? And so again, another article here, JD.com stock just hit a record low. Basically the same thing here, just taking a look at the different news pieces. And it fell to 2019 levels. So this is interesting to me. It's like it's a 5-year low or so. And it may be a very, very interesting case right now. Now, so what is happening here with the stock? Let's take a look at the 1-year chart and see the downfall over here. At some point the stock was down, but now it's down even more, sitting at $24. Very, very interesting, I have to say. It's getting really interesting here. If we take a look at the 3-year chart, again, we are lower than that. It's basically what we talked about, remember, 2019. And the 5-year chart, this is where we're getting to like before 2019 territory, as you'll see, for instance, here, where the stock was about $24.6 back in February 2019. So it's about 5 years now. Really interesting here, and it really sparks my curiosity for a potential purchase right here. It makes a ton of sense. The stock was down 3% again last trading session, which is like today, a few hours ago. Actually, the market is still open as I'm making this video for like an hour more. And the P ratio of the company, take a look at this one, 12.8 right now. It has had its ups and downs, because the company's net income hasn't been positive throughout the years. But now it's getting to become more solid and sitting at 12.8 with a price to free cash flow that is 7.3, and for a while now pretty much on the low side. It's getting really, really interesting here, and it's a case for the company to be buying back stock, of course, and they have been buying back quite some stock through the years, although recently not so much. The total liabilities of the company compared to free cash flow, about 9, which means that it would take about 9 years of last year's free cash flow to make up for all the total liabilities that the company has right now. We're going to examine the actual statements in a little bit more detail. But you will see here pretty nice revenue growth here. It's stalling a little bit. This happens again through the pandemic years. Companies have suffered a little bit. They did have some issues with their net income, of course, going down for a while. And the free cash flow pretty much growing at a nice pace as well, with the total equity also growing at a pretty solid pace, even though they have been buying back shares. Again, not so much recently. Now, their net income margins have really suffered lately, and so they are sitting at like a 2% right now. And obviously, these are not great to see. At some point, they were like 7%, but still relatively low. And, it's not a company that has wide margins, and this is important for profitability. So I wouldn't give it a similar pass to what I would give, for example, Google or Meta, just because of the margins. Really, really important, because margins are about profitability and super important. So what about the financial statements though? Because, regardless of the margins, if you are deeply profitable compared to your stock price, you are still a buy. So what is going on here? I'll take it back 10 years actually, see what we are having over here. And you will see that we started with 11 billion in revenue back in 2013, and now we're sitting on 151. So tremendous. As you can understand, absolutely amazing growth. And net income, which has been going back and forth. Again, they had some really profitable years, then negative years, then back to profitability. So it's something to look out for. But this is one of the core reasons why the stock price has been suffering, of course. The fact that they haven't been performing that well in regards to their net income. obviously would bring the stock price down. But now as they're heading back to profitability, it may be that the fear has actually caused people to flee a little bit more than what you would expect, or what you should expect. What about the balance sheet? In 2022, the company's assets, the total equity pretty much, from 8 billion back in 2018, from 8.6 billion to 30. So pretty much growing their total equity at a very, very solid pace as well. Nice to see. Okay, what about their cash flow? What is happening with the company's cash flow? Again, the net income has been up and down a little bit, but the operating cash flow, after adjusting for the usual stuff, stock-based compensation, depreciation, amortization, some changes in working capital, of course, accounted for the cash flow. Then if you are taking a look at the operating cash flow, which is about 8.3 billion, you extract the capital expenditures, so you get to about 5.1 billion in free cash flow, solidly increasing through the years, although again, in the pandemic times, things were a little bit rougher than you would want, but still pretty solid free cash flow here for the company. Now, it's always worthwhile taking a look at the stock evaluation, of course, and our discounted cash flow model, because it will tell us the story of the stock's evaluation, pretty much how much it's worth to us today. And obviously the net income margins are going to play a deep role here. But the revenue growth that the company has been achieving, you will see it here, on average, has been 23%. That's on average. Again, last year not so great, but the previous year is pretty nice. Because of last year's stall, I will have to go a little bit less than that, just be a little bit more conservative. So I will go 5, 8, and 11 here for the company's revenue growth. Obviously, you can always take a look at what people are saying online, like analysts and stuff, and decide which kind of revenue growth makes sense, or even take a look at the company's own statements about their expected revenue growth. They can be a little bit inflated, and always account for that, just go a little bit lower. But I do like to be using historical data, because what has happened in the history can actually point to what potentially is going to be happening in the future. And with a little bit of conservatism, that can actually be a good guide. The net income margins, again, 1%, 2%, 1%, 1.7, on average 1.7. So I'm going to go 1, 1.3, and 1.6 for our net income margin. And the free cash flow margin that I'm going to be using, all over the place, because again, obviously the company has been having troubles with their net income, with their free cash flow. So I will use the typical 80, 90, and 100. And the annual return that I'm going to be asking for, 13%. So let's see what we're getting if we hit calculate here for the stock. Okay, the current price is sitting at 24. The low estimates, obviously really low estimates with 1% net income margin. As you can understand, a slight difference in the net income margin here will obviously really move the stock upwards or downwards. The stock price, that is the expected one, makes sense. But for these kinds of estimates, we are sitting at a 12 over here. Again, these are very conservative. Even these are relatively conservative. And 21 for the max price to pay when we're looking at our medium estimates, with the current price sitting at 24 and a high of 32.6 over here, with the estimates of 11% revenue growth and 1.6 net income margin, which frankly the company could likely achieve. But it's not like the company is like super cheap as it is right now, but it's not expensive either, sitting at $24. So what I think about this one is I could definitely see it go lower potentially, just because of these troubles that they are having. And the P ratio, the free cash flow look great, but they can be a little bit deceiving, because you always need to account for what is going on with the actual margins as well. And this is why the tool actually shines here and tells us a little bit more about the company's actual financials, pretty much, and what you should be expecting out of them. But it's not a super expensive one to buy either. So a medium of 21 with the current price of 24, I could definitely see somebody getting a stake here, and I could also see the stock price going lower. To be frank, it really depends on what is going to be happening in regards to the news out of China. The actual sentiment right now, which can drag on for a while. So if I would be looking to enter JD, this may be a nice opportunity to grab some. And so, for instance, if I'm looking to buy, let's just say $10,000 of JD, it could be an opportunity to buy 3,000, for instance, next week. It's not a bad price at all. And then maybe wait it out a little bit, see what is going to be happening in the next few trading sessions, and potentially add some more as the stock price goes down, if it does go down. But it's not like it's a super bargain. It's not expensive either. It is a stock though that it's getting at a really interesting point for me, and I could definitely see myself adding it for a long-term hold here. So yeah, that's what I think about JD. Interesting company and obviously interesting price, which is even better. Thank you for watching. Do tell me what you think about JD, guys, whether you own it, whether you are thinking about buying it, because I think it's very interesting over here. And I will see you in the next video. Bye bye for now.